All right, well, what we can say about today, it was a day that we don't see very often. The Russell 2000 up over 3%, the NASDAQ down more than 2%. That is not a very common occurrence. So we're going to kind of break down this bifurcated move where mega caps really, and it was really in the NASDAQ 100 and the S&P 500 for that matter, it was really only a very small segment of stocks that did so much damage. But the problem is it was the small segment of stocks that did so much damage. And then, of course, everything else, Russell 2000 rallying, again, to a very large degree. So we're going to break all that down, some interesting patterns. When were some other times we saw such extreme moves in the Russell 2000 like we saw today? We kind of went into, like we've been looking for a big breakout move to occur one way or the other in the Russell 2000 based off of the patterns we've been seeing the past few days. So we got that today, but it was so extreme. So what does that mean? And then, like I said, so extreme in terms of its relative move versus the Qs. So we're going to break all that action down. What's driving a lot of that? Some big moves in some other assets, especially in yields. What does that mean going forward from here? Sector moves. We'll break down kind of what sectors tend to do well when rates fall, which is kind of the hope right now that rates will start falling here. So we'll talk about what does well in that environment. And then we'll take a look at our trade idea of the day, which, like the Russell 2000, was very much under the radar, had been not doing very well like the rest of the markets, but then broke out in a big way today. So we'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, July 11th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who click on this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks and help us to get to 100. 100 is the big goal that we have for likes on our Market Outlook tweet. Let's get started taking a look at the S&P 500 with the market forecast indicator like we always do. So the S&P is down almost 1%, down 0.88% there. You can see pretty much just reversing yesterday's move is all it did. Remember, we had the first 1% move in either direction in months yesterday. The intermediate line dropped, or not months, but weeks. The intermediate line dropped a little bit, but still extremely high. The near-term line dropped out of bullish territory, still has not gotten into bearish territory yet. That's when we can get that near-term low point, so we can bounce off the near-term low and start a new near-term rally. But this near-term rally appears to be over with it falling out and the momentum line dropping into the reversal zone. So again, this, like we talked about 2 days ago, this is an intermediate confirmation signal, the combination of a strong bullish posture with the near-term line, or momentum line, that's oversold, but not too extremely oversold. It would be better if the near-term line was below 50, ideally even better below 40. Then we can bounce back up. But regardless, that's not part of the signal. That just increases the chances for a positive outcome on the signal. But this is a bullish signal nonetheless. This, again, the combination of the green line being high and the red line being low, essentially. As you've seen on all these other lows, the red line doesn't stay low for very long unless we are full on in bearish mode. Again, if you're thinking about a bearish low point developing, then we were above 80 or at least above 60 here yesterday, not today, but yesterday at 87. Today we got to 56, so we need to drop below 20 tomorrow. If we're actually going to be bearish, we need to be bearish enough to drop below 20 tomorrow, and unlikely considering that we are still above 50. So most likely we'll drop down maybe below 40 as the momentum line bounces up, and then we'll probably bounce up out of that, form a bullish near-term low, bounce up, and resume the bullish trend that we're on. The market sentiment's still very strong. We're still 2.5% despite the drop. We're still more than 2.5% above the moving average. So we're still okay there. The NASDAQ, of course, dropped more than 2%, 2.25%. The last time we had a bigger than 2% decline with the NASDAQ being above its 30-day moving average was right here, that day right there, June 20th. All the other 2% declines occurred below the 30-day moving average. Remember, you always get bigger moves below the averages than you do above them. But this is a 2% decline that we have above it. So, and you can see this decline, this intermediate decline started with like a 1.88, I believe, decline. So, there's a good chance that while we might not be like in dark pink shading and a red line now, there's a good chance, and you notice that we didn't go straight down after even that move on July 20th of last year. We kind of went up and down, but that kind of stopped. Like we stopped being bullish, right? The peak was set. So the peak might be set, but we might not necessarily go straight down from here. Same pattern that we're seeing on the market forecast that you see on the NASDAQ, as you see on the S&P. The Dow Jones Industrial Average came close to a new all-time closing high, which is around just over 40,000. We're back up almost to 40,000 after yesterday's move. That was kind of a breakout move, and then today kind of holding, incidentally, below average range today. As crazy as today was, it was a below average range, but again, your near-term line went from below 40 to above 80 in 2 days. That's a good sign. We talked last night, the high probability of that happening because of how strong the momentum line was. Well, that happened. The intermediate line's now in the reversal zone itself. It's rising. Market sentiment's rising. Everything's looking much better on the Dow than what we have been looking previously. Finally, the Russell like that. We talked about the potential for a big breakout move this week. We finally got it, right? This was that big breakout move. Again, the momentum, near-term line spiking up, not surprisingly. Big time rally, 3.5%, which is kind of surprising. It's one of your bigger ratio moves on the Qs relative to IWM, the biggest declines on the Qs on a relative basis, with the Russell up so much and the Q's down so much. That's like I said, usually that kind of move. Well, in fact, if you take a look at the ratio chart here, let's pull up the ratio chart so we can see that. There it is. Pull this up here. There it is. So let's look at. I've got it up here. The one day rate of change. So that big decline in this ratio, dropping all the way below these moving averages. We haven't seen that big of a decline since 2020, notably since the early 2021, and then right here in November when we had the reopening trade, right? The reopening with the vaccine rollout. And then before that, that's it. Those are the only 3 times since 2020 we've had that big of a drop. This one broke the 200-day moving average. This one, remember, was already below the 200-day. We are neither, right? We broke the 30-day. But, that's a change. Remember, we're very strongly correlated. This ratio is very strongly correlated with the S&P. So a continued drop in this would not be the most bullish of patterns. Very clearly bearish signals across the board on all these indicators here for the ratio. So one day we'll see what that turns out. But looking at this for one day, that's a pretty significant breakdown in the ratio that, considering its positive correlation with the S&P, is not a welcome sight in the least bit. All right, now let's take a look at the weekly charts here. So we'll look at the weekly chart for the S&P, still looking great, but we want to take a look at the Russell since that was our big mover. Look at that big bullish candle. We finally got a green arrow again, so back above the 10-week exponential, which is rising. The PPO is rising, so and it's a relatively bullish candle, closing above a lot of highs here. So very, very good sign for the markets from that perspective, for the Russell at least. Obviously, you have 3 green arrows now, even with the pullbacks in the S&P and the NASDAQ. You have 3 green arrows, but we definitely have 3 green arrows on the Russell and the Dow. And look at that big volume on IWM. Big time breakout move on the Russell 2000. Looking at the DMI, or the two line versions course, you're still above. I mean, even with the decline, you're still above the 8-day. You're barely below the 8-day on the Qs, but barely. That, again, it goes to show just how strongly bullish those indexes were. But IWM breaking out big time, breaking above the value area. Did we end up with the highest close? So the close there was 210. So yeah, we barely ended up with a new 52-week closing high on IWM at least. And then let's see this one. Yeah, you ended up with a 52-week closing high on the Russell 2000 as well. Not a new 52-week high, but a 52-week closing high for the Russell as we are clearing up above the value area, above the point of control, above all these moving averages, big bullish stochastic and MACD indicators. Great chart there. Looking at the RSI and the CCI, you're still pretty bullish on the S&P despite the fact that you're down. But big bullish breakout on. I mean, look at that, 3, and we haven't been this far up on the CCI for the Russell 2000. I mean, you have to, even until those moves in 2020 we talked about, and the reopening trade. I mean, even that didn't get up there. This is one of the bigger moves. Here, let's just go see when was the last time we've been above 300. Because I don't see an instance here. That would be the closest instance right there. Let me put my cursor so you can be able to see that. So right there would be the closest in 2001. May of 2001, we got up to 300 on the CCI, and that ended up being pretty much the peak for the Russell. At least for that particular year, that ended up being the calendar year peak in May of 2001. And then that would be really the only other instance that we've had. Even the big fake out move that we had in 2021, the one I've warned us about, right? Because breaking up is one thing, but it's got to hold it, right? You can't do what we saw there in 21, which is a very similar scenario to what we're seeing right now, where it broke out and everything looked great, and then we broke back down, right? It ended up being a fake out. Even that one, we only got to 223 on the CCI. If you take a look at the Ichimoku Cloud, still looking good here, even with the pullback, so no big concerns. But on IWM, look at that, breaking way above the cloud, big positive rate of change, and now we have a weak bullish trend, at least a weak bullish trend. So that's good, right? It's got to start somewhere, and so we're starting there. But you can see the S&P 500 still in the upper quartile of its bandwidth, still above the Keltner channel despite the drop. But IWM finally did break out way above the Bollinger bandwidth. In fact, again, the last time that we've had the bandwidth get so high was back over here in January of 2020. That we closed that far above the upper Bollinger Band was January of 2020. And you can see we end up closing below the lower Bollinger Band just within a couple of weeks. Same thing here in 2021. We ended up kind of peaking there for the year until that breakout pattern at the end of the year. That ended up being the peak for the year. And again, you can kind of see just how rare this type of move was. You had to go back to 2010 when we were this far above the moving average with a very, very low, not as low as we are now, but a very low Bollinger bandwidth. And you get the breakout there. And then actually started a new bullish trend. A year later, we weren't bullish because of the 2011 correction, but you get the idea. So a big move higher in CCI, big, abnormal move higher in the above the upper Bollinger Band, and again, way above the upper Keltner channel. We still don't even have green dots yet. That's how kind of new this move is. You can see it did produce a new 4-week high point. SPY still keeps getting new 4-week highs, but IWM, remember how the two of these were back here? Well, now we did get a new 4-week high. So we don't have to worry about that being the new 4-week high point anymore because we got a new one today, closing near the highs of the day today, 3.6%. We have to be aware of that gap, but right now looking like a breakaway gap, or if you want to call it a runaway gap, that has very good, so very good chance we do not fill that in because it does not have the makings of a common gap. And again, if we do fill it in, that will be like the fake out that we want to avoid. Again, you go back to that 2021 period right here, and we had a pretty decent breakout gap up here, and then we continued higher throughout the rest of the day. So very similar type of move there on November 1st. We continued higher, and then within a few weeks we had filled in that gap that we didn't really want to fill in. So it's kind of the same thing we're seeing here with IWM. IWM also getting into, finally, the S&P broke out of its below the 80th percentile, broke down, below that, but the Russell finally broke into it, right, getting up to the, just the 4-week, today's high was the 4-week high, so that's how close we were to the 4-week high, which happens to be today's high. So good strong move that, again, we hope will be more than just a one day move, that we can hold this through the rest of this week and hold it ideally through the end of next week as well. Obviously, we have a pretty good range, above average range, above average volume, especially in the S&P. That's good because we were so extremely low. You see that in the ATR. We are creeping back up. We're not back above the 0.8% yet, but we're creeping back up. And again, that typically coincides with weakness, as we saw over here. So hopefully it ends up, it doesn't end up being too dramatic. IWM really jumped up, and again, not typically associated with bullishness when this rises. So if we're going to stay bullish here, we need to come way back down. I mean, you're above the ATR, but it was really a lot more than that. Much bigger range, and the volume was very, very big. Right, so the close here at 203, the low at 206.94. So you have to add in basically another 3.5 points to this. So you're looking at almost 8 points of total range compared to the ATR, and then 60 million shares trading. Just for some perspective, like, that's off the charts, literally off the charts relative to their averages. 8 points is way off the charts here. 60 million is way off the charts here. So you typically, you don't typically want such extreme moves because, again, it's kind of hard to build on such extremes. Right now, if you had a 4 or 5 point move relative to a 2.5 point ATR and 45 million, then you can build on that because it's not so it's strong, but it's not so extreme. This one appears to be, especially with that CCI and especially with that Bollinger Band %B, appears to be a little too extreme. Looking at our VIX, and we knew that there would be a big breakout, right? We knew because it had been compressing so much. Your VVIX went up more, so you're continuing to move higher there towards 85, though the VIX was up today. Not surprising that the VIX was up considering the S&P was down, but it is a little surprising considering most of the stocks in the S&P was up. In fact, we'll take a look at that here in a second. You had a good big jump in the number of stocks above the 50-day moving average in the S&P 500 today. In fact, we can go ahead and start off this segment with taking a look at that. Well, we can start here. We can take a look at it right here. The number of stocks above their 50-day moving average spiking up in a big way today. Getting above the 300 mark, that magical 300 mark, 60% of the S&P 500. Bullish territory when you get above 60. So again, at 317, good move. You can see the rate of change, one of the bigger jumps that we've seen since back over here when we were really low, and you're trying to come off these lows. So good strong change. You can see that also had an impact on the ratio of the number of stocks above the 200 relative to the number of stocks above the 50. That dropped big, and remember, when you're below the average and the average is falling, it's actually really bullish for equities. It's a good it's a good momentum move for the markets, even though we're not necessarily coming off of a low point right now. Regardless, we'll take it, right? We'll take it no matter when we get it. This is the number of stocks above the 200, was already above 300 stocks. The 50% mark really is the key there on that one. As long as you're above 50, you're fine, and that's kind of how we've been since we got above 50 over here last November. So we're good there. The number of new highs relative to new lows, big jump, again, up to 500. We haven't seen that kind of a level for a while, right? We did see that over here. That ended up being the peak right before that 5% pullback. Regardless, a good move. You see that as well in the McClellan oscillator. You had a big jump in the McClellan oscillator above 35, ended up at 52. So that's a good sign from a breadth standpoint. And then you look at the money flow. There we go. You can pull up the money flow here. And remember, it hasn't been so good. The money flow hasn't. But we are, we have pushed up. The oscillator's not back above 60 yet, and we did drop down because we actually fell on the S&P. But again, at least we are finally up above this old high point, and we're holding. We had a little bit of a pullback. We held it, and we're back up again. Now we're not back up to strong levels. Again, like I said, we're still kind of in neutral levels here, but at least we're not at bearish. We have been flirting with bearishness, and then we're not bearish anymore. So that's a very, very, from a money flow standpoint, a good sign. If you look at IWM for this breakout move, again, you can see we are closing, or at least we ended up closing above this high point over here, and well above this high point post May options expiration, and we finally did clear the volume level on that as well, and well up above the volume relative to there. And again, still in neutral levels, but working its way towards bullish levels from a money flow standpoint. So looking really, really good. The only thing that obviously is not looking good is the fact that all of these magnificent 7+ companies pretty much all dropped today. 8% on Tesla, 4%. I mean, all big candles towards moving averages. Netflix is really the only one that dropped below its moving average. Qualcomm was kind of already below its moving average. But everything else dropping towards their moving averages. Nvidia probably the closest to crossing below it again here with a 5.5% decline today. So that's really we don't necessarily want these companies to start breaking down and showing bearishness and showing, there's a couple light pink shadings. Most of this is all still dark green because they're above the 80th percentile. They're all falling, right? Falling. All the intermediate lines falling except for AMD. But at least they're still above 80, so that keeps it dark green. Qualcomm, of course, is the only dark pink. So we want to try to avoid, and this is really, Netflix is the only one giving us the bull tag, right? The light pink shading and the yellow line. These two are, remember, still above their moving averages. So as long as we can avoid these stocks forming kind of bearish market forecast patterns, then we'll be okay. Because the leadership, even when you look at the leadership here over the past 3 months, finally utilities is outperforming the S&P. Now you have two sectors outperforming the S&P over the past 3 months. But the big winners the past couple of days, industrials, materials, energy, real estate, these are all big losers, right? And that's, they were down in a 3-month period relative to big gains on XLK. So right now, their rallies are just oversold bounces from a relative perspective. When you look at take a look at XLK relative to say XLI, right? We are so bullish on this, and it's very, very bullish. But you're starting to see some weakness with these divergences on these oscillators, and you finally broke down below the 17. Now we did it over here too. We had a big drop back in June 24th, and that ended up being a one-day phenomenon, and we continued higher. I don't know necessarily this will be a one-day phenomenon, but I also don't know if this continues lower, if the markets will end up being bullish. As we saw today, it wasn't, except for the Russell, it wasn't necessarily bullish, and I don't know if the Russell can keep going up if these other sectors don't. These bigger, if they start to underperform, and they underperformed today in a very big way, right? When you look at just today alone here, they were down. They were the only three sectors that underperformed the S&P. Everything else outperformed. But utilities and real estate were your big winners today. I don't know if necessarily that's the most motivating sector leadership, to have utilities and real estate leading the way higher. And we know why, right? The big reason why they're leading the way higher is because rates fell. This is the lowest close on the 10-year yield going back to March of this year, when and we had dropped to almost 4%, a little bit below 4%. Well, it looks like we got to 4.03% as on a low point there. So we were falling to 4%. Now we're at 4.19. We got a cluster here, and we'll see how that plays out. So it is a pretty significant drop in yields, but that's why, like, again, that's not the most. And I looked at, like, again, we talked about this idea of rates falling, right? The Fed might start raising or cutting rates. So 2019 was the last time the Fed cut rates, and we weren't inverted, but it was just kind of it wasn't necessarily a rate cut cycle. It was just it was a mid-cycle adjustment is what they called it. But rates fell, and you can see they fell from October 2000. Well, really the short term kind of peaked here in February of 2019 and dropped down to about the end of October. Is where it dropped down before COVID made it really drop. So that was our kind of mid-cycle adjustment when those rates fell. So if I were to look at February of 2000, so let's go to 2019, and it was the end of February, so we'll go March 1st, and then we'll go through the end of October of 2019 to kind of give you an idea of what does well during a falling rate environment. XLK, XLC, and XLY were still outperformers, but XLP, XLU, and XLRE were your big winners. The market was up 9% during that rate cut cycle, that mini cut cycle, which some people think that's kind of what we're going to get here, maybe just a one-off, maybe two or three. But your safe haven sectors end up doing the best. These other cyclical areas still lag the markets. I mean, they have some of their times where they do well, but for the most part, the big mega caps will still do well because that's how market cap weighted index works. But now they'll probably be joined by interest rate sensitive areas, sectors that do better when rates fall, and that would be real estate, utilities, and to a lesser degree, consumer staples. So when you look at XLY versus XLP, which is a common risk appetite ratio, big engulfing pattern, big breakdown today, positively correlated with the markets. I don't know necessarily if that's it's such a big move. I don't know if necessarily we want that to reverse because, again, positive correlation with equities and risk appetite would suggest that the move on the NASDAQ and the S&P is what we can expect going forward, and not the move that we saw on the Russell today. That will end up being the anomaly. All right, for our trade idea of the day, I want to take a look at another kind of like Russell 2000, another stock that's breaking out, and that's in the home builder area. This DR Horton. Look at that nice little breakout pattern there, breaking above the moving average by a large amount. Intermediate line is rising, still in bearish territory, but rising. We're almost 6% above, and we're not anywhere close to being too far above. So there's plenty of room for it to go. The near-term line is finally in the upper reversal zone, so that's a good sign. With that momentum line getting up there as well. When you look at the weekly chart for DR Horton, you can see a big transition candle this week, closing above the 10-week moving average. Very good sign, especially when that transition candle on the Hakinyashi is paired with a regular candle that's very bullish. So very, very good sign there. Obviously, you have 3 green arrows on the stock with a lot of volume today, 1.5 times the average volume. New 3 green arrows and a green line, no less. So very, very good. I mean, when you get 3 green arrows in a day, which again, usually it's the moving average is the last green arrow. Not always, but usually that one's the last green arrow. And you get the moving average turning higher where it was lower the day before that. And then you have the 1.5 times. That's a very, very good day for a good kind of breakout pattern. When you look at the DMI, you're going to start seeing a lot of breakout patterns here. The DMI's got a breakout pattern well above 30, below 20 on the negative. So your ADX is so low, it looks like, again, it's just starting. Your RSI and your CCI also broke out about almost a 200 on the CCI, so not extreme like the Russell, but above 60 there. If you look at the weekly CCI, again, it looks like we're just getting started. It's still negative. When you look at the Ichimoku cloud, We had a bearish trend. It's gone. We're not through the cloud yet, so we're not even like above. Like we haven't even turned green yet on the cloud. So again, it could very well be the very beginning stages of a move. You ended up closing above the upper Bollinger Band and closing above by a pretty decent amount, and the upper Keltner channel. The momentum is actually still negative, so it hasn't even turned positive yet, and you just don't have green dots yet. So again, it looks like we're in the very infant stages of a move. So what I decided to do was be a little aggressive with a long call vertical spread with the August expiration, selling the 20 delta, buying one strike away. So getting about a 4-to-1 reward to risk ratio, almost 4-to-1 with our normal $500 of risk to set that up. So and that's how much flexibility we have with timing. So if that maximum gain comes out of the window, then we'll probably end up closing the trade with whatever gain or loss we have at that time. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.